Before we start, just like to acknowledge the traditional owners and the lands in which we are meeting around New South Wales and the country, and pay my respects to elders past, present and emerging. I'd like to welcome Joe Bills. Joe and I go back a long way, been knocking around the industry for a while. And Joe's now with EverAg. I always used to know I was with Fresh Agenda, but that's changed recently. And yeah, Joe's going to give us an update on what's happening with the global and domestic market and the drivers of those. I do know, we had our milk price announcements recently. There's a bit of a sluggish international market. Understand there's a fair bit of pressure on processors, but you might be able to shed a little bit of light on that for us, Joe. We'll keep questions to the end, and we'll leave a little bit of time for questions, hopefully at the end. So welcome, Joe, and thank you. And I'll hand over to you, to the controls, to yourself.
Thanks very much, Ken and Blake and everyone for having me this morning. It is an opportune time to talk about what's happening in global domestic markets. It's been an interesting few months. I think the last time I did this breakfast, it was March. So we were wondering what the opening price for the coming season was going to be. Obviously, we're past that period, but still a fairly interesting time for the Australian industry. So given that I'm doing a talk on global and domestic markets, you probably know the answer to this one, but do global markets matter? We often get the information around how much we're exporting these days. It's sitting around 30%. Back in the day, we were exporting around 60% of Australian milk production. It's now down around 30%, but the international market still matters because Australia is a part of it. So trade still matters for 70% of our milk that is tradable products. We have free trade agreements with New Zealand and the US, and we still export obviously around 30% of our production. We import around 30% of what we consume in Australia. So the trade of dairy products still very much matters. Global sourcing strategies are very much in play, from quick service restaurants, so the McDonald's, the Hungry Jack's, the Domino's, and also our retailers, particularly for some of their private label products, are also using international sourcing strategies to manage costs. Fresh products account for about 30% of our milk these days, and that's obviously a more local focus and more relevant for parts of New South Wales and southern Queensland. A little bit more insulated from volatility, but given the influence on southern milk prices, global trade still really does matter. And you can just see on the right-hand side, we've done a little tally up of the Australian manufacturing milk balance, and we're still exporting slightly more in milk solids equivalents than we import, but you can see these days it's a very close run thing. Imports are influenced by how much product we have here in Australia. So you can see just on the left-hand side, our cheese imports really trended upwards through 2023 when we didn't have a whole lot of production here in Australia. But as we had just that little tick up in Australian milk production in the southern region and a bit more cheese produced, we have seen those imports come down. And similarly with Australian butter and AMF, we do have a structural shortage of fat in Australia. So imports are a feature of our butter market. But you can see, just as that local production has ticked up in the last few months, that our import requirements have trended down. But again, we're still exposed to trade, whether we're importing or exporting, for those long shelf life products like butter, skim milk powder and cheese, which is the biggest part of our production. Something we've been tracking for some time in Fresh Agenda and now as part of EverAg is the commodity milk value, or the CMV. And basically that's a basket of our product mix, all the commodities that we produce in Australia. We make an allowance for conversion costs and some profit retention, and we come up with a commodity milk value expressed in dollars per kilogram milk solids. So that's really trying to track what milk is worth based on the value of the commodities that are being sold by the industry. And we did see through that 2023 period this sustained quite long period of our domestic CMV just trending above the New Zealand CMV. And part of that was due to the dynamics around sourcing strategies of one of the major retailers. They made a commitment to Australian private label product and sourced milk on farm. And that really put a backbone into that commodity milk value, because our price of cheese within Australia was quite a bit higher than the international benchmarks. But you can see what happens. High prices, as they say, do cure high prices. As we saw that increase in imported product, we quickly saw that commodity milk value for Australian product versus New Zealand product pretty much come back into alignment in the last 6 months or so. So hopefully, having convinced you that the global market matters, here's a little bit of an overview of what's happening in the global market. And I only put up this very long list so that you'll be relieved that I'm only going to talk about a couple of things in this very long list. But it's just to say that there are a whole lot of supply and demand factors in the global market, as Ken said, particularly sluggish demand at the moment. On the supply side, though, we've seen really limited milk growth out of most major exporting regions. In the EU, we've got rising milk prices and good pasture conditions, although there are some emerging concerns about crops within Europe that may affect the margins that farmers are facing as they go into the colder months. We have seen some excessive wet conditions that are affecting feed quality and availability, and that's really starting to impact on milk solids within the European Union. The US, we're having improving income over feed costs, but what we're really seeing is a limit on young stocks. So the availability of heifers is chronically limiting US milk growth. We're seeing higher capital costs with increased interest rates and the costs of everything. And given we've got old cows still in the herd, we're starting to see those lower yields really impact the ability of the US to grow. In New Zealand, margins over operating costs are really tough at the moment. The announced price with a midpoint of about $8 per kilogram milk solids in New Zealand terms is below the cost of production for many, and certainly below the cost of servicing debt. And so that's really going to limit milk production in New Zealand over the next 12 months or so. It's really going to depend on them having a good season. So milk solids output has been flat for the last 3 years, and that's really been the most supportive thing for commodity prices. And a whole range of factors have really influenced that. So in terms of global trade, this is on the left-hand side, the annualized trade in milk solids equivalent of dairy commodities. And you can see it kind of ticked up in the beginning of 2024. Based on lower commodity prices, we saw a lot of supply lines being filled at these low prices. But since then, we've just seen that level of milk trade trending down. On the right-hand side, we've got the net import demand, and when it's below the line, it basically means that supply is in excess of demand. Skim milk powder and butter prices have really been held up by high value of butter, but skim milk powder protein prices have generally been quite subdued over the last 12 months. So in terms of domestic demand, we're seeing a weak demand recovery. The global impacts of inflation on household incomes and spending has really hit dairy as it's hit everything else. And we're seeing a really weak recovery in overall trade. China is obviously the key market that we look to, and that's still very much in a weak state. The economic situation in China isn't improving. The Chinese government has made the decision not to pump prime the economy as they have in the past. And so we're really seeing this grind down in terms of demand. UHT demand has improved a little, but is still quite subdued. Whole milk powder, skim milk powder stocks to use is reducing, but they're still quite high stocks. and that's impacting the requirement for imports. In terms of the consumer, they're still very cautious about their spending. And interestingly, and unfortunately, I guess, for exporters, the perceptions of local products have really changed in China. The melamine incidents of 2008 are very much in the rearview mirror. That's been a concerted effort by the government to improve confidence in local products. And so there's not that strong preference for imports anymore. We've also seen this very patchy fast food growth. Responses to very deep promotions, cuts in prices, but still very patchy. So on the farm side, we hear a lot about the moves to self-sufficiency in China, and that still is very much a thing. But we're seeing growth in milk output growing. In the second quarter of this year, it was expected to be about 4.5% year on year, but it came in at 1.9%. But despite slower than expected milk growth, farm gate prices are still falling for China. So that means that farm projects have slowed and the requirement for imported live heifers has really reduced. So this is what we're seeing in terms of China's import requirement. Again, a rolling annual milk solids equivalent, and you can just see that relentless trend downwards since basically it peaked in 2021, just coming out of that COVID period. We really have to reset our thinking. We had a similar thing happen back in 2014 where we really had to reset the kind of market that China is. There will be higher self-sufficiency for China, and there's no preference now for imported ingredients. And given the economic outlook and the attitude of the Chinese government, we will see a weak economy for some time. So what that really means, in particular for New Zealand, is a spillover effect that in turn affects us. With lower Chinese whole milk powder demand, New Zealand's had to look for other markets for its whole milk powder. And luckily, with Latin America having some weather difficulties, they have been able to place whole milk powder in other markets. But overall, New Zealand's taken the strategic decision to reduce its whole milk powder production, try and increase cheese, and certainly it's increased its skim milk powder and butter fat output. We are seeing the limitations, as I said, on New Zealand milk supply, and they are seeing the very intense cheese competition in contestable markets in our region. So really, skim milk powder and butter fat has been the area that they've put most emphasis on as they try to manage that whole milk powder exposure. We've seen reduced EU and US stocks of skim milk powder, but given the availability out of New Zealand, we really haven't seen skim milk powder prices respond to that low stock situation, despite the fact that US and EU are very tight in terms of skim milk powder. And this gives you a bit of an overview of what's happened in the New Zealand shift. So you can see there on the left-hand side, in 2021, the proportion of New Zealand exports going to China and Hong Kong and how significantly that's shifted by 2023. And we've seen those exports in different products going across to Southeast Asia. Certainly the Middle East and North Africa has been an important market, and a little bit more into Oceania, which basically means Australia. North America is obviously another interesting market for New Zealand, mostly for butterfat, and obviously the pricing differentials have to be favourable for that to happen. So again, on the right-hand side, you can just see that shift into skim milk powder and butterfat as they've tried to manage their whole milk powder exposure. The other interesting thing that I wanted to talk about in terms of global markets was US cheese capacity. And this is a map of all of the investments that are happening in the US right now in terms of adding cheese capacity. And that's all the sort of dark greenish spots in there. You can see them all through the middle of the country there. Some major investments in terms of cheese capacity coming on stream at the end of 2024 and into 2025. And it's a little bit scary because what we're seeing is those blocks of colour on this chart are the capacity being added, when they're being added. and what has to happen in terms of internal cheese demand, US cheese demand, to actually soak up that production. So cheese demand in the last 12 months has not been that great, which is a little bit concerning and confusing. Usually when we see a downturn or some pressure on household incomes in the US, we see a lot of US consumers trading down to cheese rich food offerings, particularly for takeaway, pizzas, burgers and the like. We haven't really seen that in this cycle. So we really need to see that cheese demand tick up a little bit as this cheese capacity comes online. Otherwise, obviously, a lot of that cheese will make it to the export market, and Australia is very much a target for that cheese. US milk production, again, is struggling. So one of the talking points in the US at the moment is how will those cheese factories actually be filled? Cow numbers are struggling because of this high price of young stock. And we're really seeing the impacts on yield in terms of trying to get that growth off the ground. Higher capital costs for new facilities for farming are a real barrier to expansion. And we're really seeing that US milk production struggle. So we're likely to see a similar level of competition for milk supply in the US that we've seen in Australia over the last few years as those new facilities try to get filled. And turning now to the domestic market, which is obviously an important one, particularly for New South Wales, Northern New South Wales and Southeast Queensland. And what we've seen over the last 12 months or so has been pretty resilient dairy demand. You can see there the volumes for most products, with the exception of milk, this is supermarket sales sourced from Dairy Australia, have actually still been reasonably okay in terms of volume. The value increases that have been achieved over the last 12 months have been significant. We've really seen that pass through of higher milk costs to supermarkets over the last 12 months. But that's starting to wane a little bit. The consumer sentiment that we're seeing in Australia, just with the higher cost of living and interest rates, we've seen consumer sentiment in the most negative territory for the longest expanse for quite some time. And what we're seeing on the right-hand side there is a reduction in some of those hard-won gains in terms of higher dairy product prices. Milk and cheese and ice cream and products month on month, their retail prices have been reduced, although they're still up in annual terms. But it's really one to watch as we go forward. We've seen the pressure being put on local retailers, supermarkets in terms of price gouging. There's a lot of scrutiny about pricing. And again, staple products like dairy will be targeted for promotions just so they can basically get the government off their backs. So I guess the key question is, what does this all mean for farmgate prices? And as I said at the start, the timing's a little bit different. Last time I did this breakfast, we were speculating over what opening prices would be, but obviously in July, we kind of know where we are. So I just wanted to go through the relationship between the commodity milk value and farmgate prices. The commodity milk value is really the product mix of commodities, less conversion costs. But when we're looking at farmgate prices, we're really looking at the capacity to add higher value, because a lot of our production in Australia these days isn't into basic commodities. It is into higher value added retail products. So a lot of that depends on the business model of each company and what the ability to diversify and add value is. From that, we would get a projected 4-year price range. The opening price range in normal years is really a reflection of recruitment competition, particularly in the last few years, where we've seen through the period from the 1st of June, when we've had price announcements under the mandatory code, we've seen a lot of competition that's really bid up prices through that cooling off period before the 1st of July starts. What we've really seen this season is that recruitment competition really hasn't been there. And part of that is really around the right sizing, I guess you could say, of processors. A lot of the processors in southern regions have reduced their processing footprint because they're not confident that they will get the milk to fill those factories. And so we've heard over the last 12 months, around 10 processing sites have been taken out of commission. So what we can really see there, the CMV again, compared to the farm gate price, over 22, 23, 24 seasons, we've seen that Australian price, just that dark blue dotted line up there, really a lot higher than the commodity milk value, as that competition has been really intense. And with the current season price announcement, we've seen that come significantly lower. So between 11 to 14% lower in southern regions. And it's really come back into alignment with those New Zealand prices that were well below us in the last 2 or 3 years. So in terms of what that means for New South Wales, obviously these numbers aren't finalised. The dotted numbers are our forecasts or best guesses. In Victoria, you can see that very significant downturn. In New South Wales and Queensland, with that greater exposure to year-round milk production and fresh milk markets, we haven't seen such a significant decline. It's pretty much levelled out. But obviously, that southern price is concerning in terms of the differential between New South Wales and some of those regions in Victoria. In terms of understanding what's happening with milk prices, I did just want to give a plug to the Milk Value Portal. This is a free resource for the industry. Just look up Milk Value Portal and look at the Farm Milk Value tool. And you can plug in there your region, a farm size that's similar to the size of farm that you're interested in, and a whole lot of information around fat and protein content, also what the farm characteristics are in terms of seasonality. And what gets spit out is a season average and a quarterly price for the farm in that region. And on the right-hand side, what you can see there is the dot is the weighted average price in that region for that size of farm with that profile of seasonality and fat and protein, and also the range of prices that are being paid within that region for that farm. So bit of a plug there in terms of the Milk Value Portal. There's got a lot of information about both the domestic market, what's driving domestic markets and international markets. We maintain it and try and give you the most up-to-date information. And if you are looking at the portal and want some other information, give us a yell and we'll try and help improve that portal as much as we can. So Blake and Ken, that was all I wanted to run through in terms of the presentation, but very happy to take questions if there are any.
Okay, that was fantastic. While we're waiting for questions from the room, I know you tried to convince us at the beginning about the importance of the international market. You know, New South Wales is, further you go north, it's very much a domestic focused industry. There is, I know people who say, well, we're better off with just a domestic market. It would push prices up. How do you respond to that when you hear that, when people say we don't need an international market, let's just focus on the domestic market, and that's what we do in New South Wales? What do you say to that?
Yeah, look, I understand the sentiment, I guess, of focusing on the domestic market, but the issue that we have is a lot of other people are focusing on our domestic market as well. And as demonstrated with the period of time when we had increased returns, particularly for cheese in Australia, we saw a lot of imports coming into the country. So we are an island, but we're not an island. We are an open market for imports. So we don't have the domestic market to ourselves. We will have competition, very nearby competition in New Zealand who are obviously looking to place milk in other markets apart from China. So we do still have to be competitive. We are going to be a part of the international market one way or another, whether it's through imports or exports. And I guess what participating in the international market gives Australian manufacturers is an opportunity to diversify. So we do hear a lot about how concentrated our retail market is in Australia, and it's true. So for some manufacturers, a lot of the countervailing power they have is that they can place their milk into other products in other markets that are higher returning. And so I think in terms of our industry, we need to be of a size and of I guess a competitiveness that we can have access to both our very good domestic market, but also our international markets of choice to maximise returns to farmers.
So, is there any questions from anyone who's listening? You can come off mute, or you could put it in the chat. If you can just check the chat, please, Blake. While we're waiting, I did note that growing gap between New South Wales and Victorian pricing, and that creates a dynamic in itself and a pressure within itself. What if that gap remains? What would be the consequence of that gap?
Well, I think what we find with you know, most industries or markets, the gap doesn't remain, Ken. So I think if we are in a period of sustained lower southern milk prices, there will be pressure on northern prices as well. There will be the incentive to move some of that milk from southern Australia, which is, as you know, happens all the time. We have a lot of milk moving around this country, and there will be the incentive to hop that milk up the country if the returns from manufacturing cheese or milk powders and butter aren't sufficient. So there is a risk for those northern New South Wales and Queensland prices, which is, you know, we sort of talk about southern price or northern New South Wales, northern Victorian price plus freight. That's definitely still a risk for northern prices. I think, you know, in the last few years in the northern regions, we've had kind of a nice balance in terms of supply and demand to supply those fresh milk markets in northern regions. So it will be a bit disruptive if we do have this sustained lower price in southern Australia. That will, you know, start to impinge on that northern price as well. Hopefully we are also seeing a bit of a reduction in input costs as inflation kind of subsides, and some of the input cost pressures that we've seen over the last couple of years have also reduced. But we do find over time that there is that cost plus freight differential that will probably come back into play as we go on.
I've got a question, Ken, if that's all right.
Yeah, Paul.
Thanks, Joe. It was excellent. Just wondering if, you know, sometimes things are harder to predict short term, and, you know, trends are easier to see on a much longer term scale. Just wondering, you know, if you would, putting you on the spot, be sort of prepared to sort of say, look, you know, what do you see as some of the really longer term implications for our industry in New South Wales in particular? You know, farm size, locations, you know, costs of production, you know, any you know, predictions that you're prepared to make around that, you know, looking at sort of milk price?
Yeah, look, we did do some work for the industry, Paul, late last year, just trying to understand the longer term trends for the milk pools within Australia. And that was really around understanding if we have scenarios for milk production that are, you know, higher than we are now or much lower than we are now, what will our product mix look like? Where will milk be being produced? And what does it mean in terms of milk value? And where we came out was, you know, if we can stabilise as an industry around the 8 to 8.5 billion litres, we will be an industry that's much more focused on cheese. We'll have a lot less emphasis on ingredients and our fresh milk production. And the kind of scenarios that we were running were still showing us that in New South Wales and Queensland, there will be a significant industry that will be very much focused on those fresh milk opportunities. You could see a future in the next 10 years where we've got much more, I guess, intensive farming systems. And the milk value implications of that scenario were the highest milk value of all the three scenarios. So whether we grew back to 10 billion litres and we were still exporting a bit more, or whether we shrunk down to 6 billion litres and had a lot more involvement of imported product in our market, both of those outcomes for milk price were worse than the scenario that was kind of in the middle. About we are now, maybe a bit more, with an emphasis on cheese, which we're very good at as an industry, and servicing those growing fresh markets within the region. So New South Wales, under that scenario, was a little bit bigger than we are now, but we felt with systems that were more akin to servicing a year-round fresh market, and also obviously with some of the sustainability issues addressed within those systems. So they were kind of the big trends that we saw out of that piece of work. And that's something we did for Dairy Australia, Gardner, ADPF and ADF. So hopefully that study will be doing the rounds, but if you want to have a look at it, I'm very happy to send it on to you, Paul.
Paul, any other questions?
Yeah, Ken, Scott Barnett.
Hey, Scott.
Yeah,
Hey, Scott.
thanks, Joe. Joe, to me, the most worrying slide there, if I want to put a black hat on, is the US cheese factory growth.
Yeah.
We're talking about us having a, future our fresh milk, cheese balance, etc. What, surely, 5 years, 6 years out, what are the implications of that for us? Looking further on than just, next 2 years or whatever.
Yeah, that's exactly right, Scott. And I think, the interesting discussions around the US is, okay, we're building all of this capacity, and it's a lot of capacity. It's about 5 years worth in the next 6 months. Where is this cheese going to go? They're only just thinking about it. Again, we've got to really see that local cheese demand pick up to absorb some of that additional capacity, because if it's not absorbed, it will be hitting the export market and it will be a lower price product than we produce. Unless the US changes its export stance, it will be a lower quality and less desirable than the cheese that we produce. It's not cheese that we would use in a natural cheese market in Australia, although it does find its way into processed cheese here. And it's a processing import in other markets at this point. If that cheese does not find a home in the US, and if those US manufacturers actually are able to address some of the requirements of the export market, there will be a lot of competition for cheese, both in this market in Australia and also in the contestable markets in Asia that we've been used to being very successful in. So I think you're right, Scott, to sort of have a bit of concern and watch what's happening with that cheese capacity. But the saving grace at the moment is the US is not terribly sophisticated in terms of its cheese manufacturer and export. And I don't want anyone to tell my US bosses that I just said that, but it's true. And so we do have an advantage still in terms of this market and what consumers want here, and also most of the markets within certainly the Middle East and probably Asia as well. But we need to make sure that we maintain that advantage if we possibly can.
And have you got any vision on how many of those new cheese facilities are actually linked to new milk producing facilities? I think that's fairly well down the southwest and southern parts. What about those Midwest and higher, northern Midwest areas?
Yeah, most of them, Scott, you're right, are vertically integrated. So a lot of that milk is and a lot of that investment is coming from very large corporatized family farms or groups of families that are investing in the on-farm capacity as well as the cheese capacity. The issue is going to be for other factories, other cooperatives that are collecting milk and making other things in those regions. They're going to really struggle to secure milk. But a lot of those investments have also got with them, the milk investment as well. But even for those guys, they are struggling with the issues of high-priced heifers, mostly due to dairy beef enterprises. They're just not finding that there's the heifer supply out there.
Is that going to be corrected if the US beef market corrects, like the beef herd?
Yeah. Well, that's what's going to happen. What's going to have to happen, Scott, because at the moment the return on dairy heifers is just not there to retain them in the herd, and so we're just not seeing the production of heifers that we're used to seeing. We're not seeing necessarily the use of sex semen that we were before, because the dairy beef game is very lucrative at the moment.
Thanks, Joe. Thanks, Ken.
Thanks, Scott.
Thanks, Scott. Back in I think it was 99, Joe, New Zealand was about 10 billion litres, Australia was about 10 billion litres, we're about the same. And now 25 years later, New Zealand's 22 billion, we're 8. And very different journeys and very different stories. What's the growth potential left in New Zealand, or have they maxed out? What's the next 5 years look like for New Zealand, and how does that interplay with our market?
Yeah, good question, Ken. And you and I have been around long enough to have seen that. And I've got a nice chart right back to the 90s, when we were almost in lockstep, and then New Zealand did this, and now we're both flatlining. And I think it's fair to say that a lot of that growth in New Zealand was, if you actually add up the milk solids, it's pretty much the additional demand from China. They pretty much grew in lockstep with that increased Chinese market demand. And now we're really seeing two things. China is probably not going to continue to increase as it did because of the moves to self-sufficiency, because of the economic situation within China. And also, it's not just the environmental constraints in New Zealand that we hear a lot about. It really is about the financial situation that a lot of Kiwi farmers are facing, that's really maxing out growth. So we reached peak cow in 2015 in Europe and in New Zealand. Cow numbers haven't increased in either the EU or New Zealand since then. But the ability of New Zealand to intensify and, increase yields per cow is probably a lot trickier than Europe, given the availability of supplementary feeding. And given that, particularly in the South Island, the expansion in the South Island has been such that the support blocks for dairy production have either been turned into dairy or just not available to dairy producers anymore. So it's been interesting with the new government. Obviously, the new government is wanting to be much more farmer friendly than the previous government. They've rolled back a lot of the, or they've signalled that they're rolling back a lot of the environmental restrictions. They're confirming that agriculture won't be in their ETS. But what we're hearing from New Zealand, colleagues on the ground, is that it's not going to make much difference. It's actually the finances that just aren't there anymore. So that period of time where we saw a lot of land being converted to dairy, a lot of syndicates investing in dairy land, there's no capital gains tax. They were it was really a land play. Those days are really over, and some of that land is even going back into forestry. So we see that in terms of cow numbers, New Zealand's probably peaked, and now it's going to be, can they actually improve yields with the systems, within the systems they've got, and maintain their kind of their advantage as a low input producer of milk. So, you know, it just underlines the fact, I think, Ken, that milk is hard to grow everywhere at the moment. It's not just Australia. And so our input costs across the world are increasing, and dairy commodities are going to continue to be a high price commodity for a lot of developing markets. So we've got that tension, I guess, between constrained supply but demand not quite being where we'd like it to be in terms of commodity prices. That's a really long answer, but I hope that helps.
Good answer. Yeah, we've both been around way too long to see that journey.
Yes.
All right. Any other final questions? All right, excellent. Well, another great presentation, Joe, as normal, and very informative, and gives us lots of food for thought. Some things are a little bit worrying, some things are you know, good news stories. So mixed bag as always. So yeah, thanks again for your presentation, and we'll probably try and do it again in another year's time. It's always good to get a good update on what's happening in the market. So our next breakfast is in October. So we'll send out some notifications around that when it gets closer to the date, and we'll at this stage we'll probably be looking at some of the outputs of our storm and flood program, which is coming to an end at the end of this year. So thanks everyone for joining us. We have the recording available, and I look forward to seeing you all again at our next breakfast. And thanks again, Joe.
Thanks for having me, everyone. It's been a pleasure.